to the stage for this amazing, remarkable speech by Lena Georgette.
Toastmasters and guests, I'm very excited to give you somewhat of a dry presentation today about accounting and tax, because you got to do it. There's two things you cannot escape, death and taxes, right? And I'm going to start off with a joke, because you know me, I got a joke, regardless if it's death or taxes. So I want to ask you, do you know why the accountant has to go to therapy? Anybody? Because we have too many emotional assets that we cannot balance. All right, so let's get into the presentation. So my name is Lena, and I have a company that's called From Books to Taxes. And I do everything from books to taxes, whether it's your QuickBooks accounting or filing your tax returns, doing your financial analysis. And today my goal is, in the very short period of time that I have with you, to discuss a couple of things. The first thing we're going to go over is the various types of entities you can have as an entrepreneur, and maybe there's some things that you didn't know about that you might be able to get from my presentation. And then we're going to talk about the hot topic of audit risks. So if you haven't filed your tax return, it's a good idea to listen of what some culprits are out there on your tax return. And then we're going to talk about certain changes that are happening right now in the tax world. So we're going to go to the next slide, please. And as the slide is coming up, when we practiced before, it has a few of the different types of entities. Now, when you're first starting off with a business, a lot of people do become an LLC. An LLC is a separate type of entity. You file paperwork with the state you're in, you file paperwork with the IRS, and the good news about the LLC is you outsource a lot of the liability to the separate entity that you have. As an LLC, you're a sole proprietor, and so you don't have to file a separate tax return for that entity. Everything goes on your Schedule C on your personal tax return. So it's a lot easier than if you are some of the other types of entities. However, you're double taxed because you as a sole proprietor are both the employer and the employee. So that's where they get you, with a double taxation. Now, if you get more money in your pocket, and I recommend if you make maybe $80,000 to $100,000 a year in your business, you should probably consider being an S Corp. An S Corp is a subchapter S corporation. It's also a separate entity. You have to file a separate tax return for the S Corp, and you get a K-1, which is a pass-through type of form that you put on your personal tax return. Now, the good news is you bypass the double taxation if you're an S Corp. The bad news is you have to file an actual tax return with the S Corp and get the K-1, so it's a little bit more work, and you also have to be on the payroll. And the IRS is starting to catch people who are S Corps and do not have payroll wages, and not only wages, but you have to have reasonable wages. So you can't just be like, oh, I'm the shareholder of this corporation and I'm going to make $20,000 a year when your corporation is making millions. So you have to put yourself on the payroll and research what is a reasonable salary. Now, if you have a few partners and you want to be a partnership, which is similar to the S Corp, it's the same type of process, but you don't have to have payroll when you are a partnership. So you pay yourself with distributions, and you have to have a separate tax return. You get a K-1, you put it on your 1040, which is your personal tax return. With the partnership and the S Corp, the one thing that people have to look into is when they take out distributions, sometimes that creates a taxable event. Why? Because they take out more than their bases. what is the basis in those two companies? The basis is what you contribute in the company plus or minus your net profits or net losses. And that is kind of the basis that you're working with that you can take out. If you take out more than that, and there's a calculation on your tax return, that is when sometimes the shareholders are surprised why they have to pay a capital gain. It's because they take out more than their basis. And if one day you want to be on the stock market and you want to have unlimited shareholders, you can be a C Corp, which is only taxed on a C Corp level, and you don't get any type of K1s or anything like this for your personal tax return. So we're gonna go to the next slide. Okay, so audit risks, which I think affects everybody here. And I've been a CPA since 2004, and I can give you some things that I've seen according to my clients and when they get letters and why is that the case. Now, first of all, I want to point out of the good old graph of audits that are happening. Before COVID, you could see a big spike, and then during the COVID era, from 2020 to 2024, obviously the IRS was very busy doing other things, such as changing the laws, giving money out, and stuff like that. It was predicted that now, going forward, there will be more audits. However, a lot of IRS agents are being fired, so we're not sure how many audits are going to be there. But I want to make sure that if you're filing your tax return, those are some key things I want to tell you about. So the first thing is, you don't want to have round expenses. So when you have a business, you're sole proprietor, or you have an S Corp, don't estimate your expenses. So don't put $5,000 in meals or 10,000 miles. If you're estimating, make it not round, okay? Because that is definitely a red flag. The IRS knows you don't have support for that, you made up a number. Obviously, sometimes it is a round number, but usually it is not. So keep that in mind. Don't put too much money in the miscellaneous category. That is very important. Keep it small, and you want to spread out all of the expenses in various categories. Don't miss any income. 1099s. If you know you're getting a 1099 from a vendor, don't file the tax return without it. This is very important because it gives the IRS some time to dig, oh, what else are they not including on their tax return? Crypto. This is a big one. Now all of the crypto platforms, they give you 1099s, they send the IRS 1099s, so you want to make sure that you report your crypto stuff. If you're getting a credit for earned income credit, that is a credit that is very much scrutinized, so you want to make sure that those check marks are filled out for that one. And another thing that I want to tell you is you want to make sure that year over year you're consistent with what you're reporting, because that's what the IRS looks at as well. You know, what are you reporting this year? How was it last year? And that's how you can catch even your mistakes on the tax return. All right, we'll go to the next one. All right, and just a quick update for some things that are changing. The 1099Ks, you want to make sure that you get those in your tax return. Now, the IRS is getting lower and lower numbers of the 1099. So right now, they're issuing at $20,000 if you made, but going forward, it's going to be $5,000 and then $600 for 2026. So 1099s are important for you to report. So don't file your tax return without the 1099 yet. And what I want to mention to you, some interesting research that I found out, 2024, the IRS is abolishing the knocking on the door to collect taxes. They used to do that. They used to ring your bell and collect the tax. They're not going to do that anymore. I think they realized nobody's opening the door unless you are a pizza delivery guy or working for the Amazon. So thank you very much, guys. I hope this was helpful.